Hong Kong Blockchain Week. I am Maria Vovchok, Event and Investor Relations Manager at Startup Network and an ambassador at Blockchain Association of Ukraine. Really excited to join our Blockchain Week and really excited as well to have our amazing panelists who are joining me today. So please welcome Jesus Rodriguez, STO and IntoTheBlock, ex-Microsoft X1 system architect, two-time successful entrepreneur, guest lecturer at Columbia University, active angel investor, speaker, and author. Have I missed anything, Jesus?
No, that's a good summary. Thank you very much, Maria. Happy to be here.
Thank you for joining. The next our guest is Anton Golub, who is the founder and CEO at flovtec. It's a Swiss technology company providing market-making solutions for digital asset exchanges and token issuers to create a liquid and efficient market. Anton co-founded as well Liquidity. It's a blockchain-powered exchange to trade all assets with zero fees and issued one of the world's first security tokens tradable in the secondary market. Previously, he was also a high-frequency trader and market maker in the foreign exchange markets and researched market infrastructure, liquidity, and flash crashes at UK Treasury and Alliance Manchester Business School. Anton has co-authored 13 academic papers, and 2 books, so really impressive. Also, one interesting fact about Anton, that he founded one of the first blockchain companies in Switzerland, and many people, because of that, called him a crypto dinosaur. Is that correct, Anton?
That is correct, and I take it as a big compliment, especially when people see that I'm actually not a dinosaur by age, but that's the perk of being around for quite a few years. So I wear that badge with pride.
I'll tell you honestly, this is like really funny when in a few years we already have this term like crypto dinosaur, not only about the previous finance world, but also now about crypto world as well. Our next guest is Stefan Richardson, who is the VP of Product Strategy and Business Solutions at Fireblocks. Stefan has multiple years of experience in both traditional and crypto-focused financial institutions. Prior to Fireblocks, Stefan was a senior manager within the financial services practice of Accenture Strategy, and prior to that, Stefan worked as head of strategy and head of product business for Noble Markets. He considers his main business skills effective communication, which is he finds helpful in day-to-day work, and collaboration is the key to developing effective new products. Welcome, Stefan. How are you?
I'm good. Thank you for having me.
Thank you, Stefan. And the last but not the least, we have Thomas McMahon, co-founder and CEO at Airborne Exchange. He has over 35 years of experience working with commodities and derivatives exchanges across US, Asia, and Middle East on exchange and regulatory frameworks. He specializes in exchange-traded futures and OTC product creations, clearing, trading, and helping exchanges projects obtain regulatory approval licensing. He is considered an expert in exchange architecture, derivative, and physical commodity product development. Most recently, has been working on a best practice adoption of blockchain in distributed securitization of digital commodity assets. And his life lesson is persistent is to learn from your failures, reinvent yourself periodically, and never stop learning. Welcome, Thomas. Honestly, really nice to have you today.
Thanks very much. Appreciate it.
To be honest, judging from your background, from your experience, I'm really excited actually to discuss with you our topic today, which is digital assets and beyond, infrastructure, liquidity, and analysis. So before we'll dive deep into digital asset infrastructure, for those people who, for example, maybe are watching Blockchain Week for the first time ever, in our case, one of the most exciting blockchain weeks in Hong Kong, please help me and categorize all the digital assets for all those people, so they would know exactly what type of digital assets we are talking about. So who would like to start?
Okay, I'll go first.
The floor is yours.
Yeah, no, thanks. Going back to the I know Anton, actually, we're in a conversation, and he was actually one of the first people to look at a carbon asset on an exchange through Lique in Switzerland. So one of the interesting things is I come out of the traditional markets. I've got enough of a history when we actually used to trade on the trading floors, and we wrote stuff down with pencils, and we had erasers, and you made trades, and we actually had paper. We went to computers. Now we don't have trading floors or paper. It's an evolution. But looking at the digital asset space, when I started to look at it, or when I am, and what I'm doing today is, you really got two sides of the market. You've got the purity of digital, and that's the Bitcoin and the Ethereum and all of the token economics models and the payment solutions. And the other side of it is the utilization of the blockchain and the distributed ledger architectures and Ethereum, or the methodologies that you can represent assets digitally, but actually have a backed asset. And there's a real stream going two different ways on that. And the regulators are very fun. Regulators are very focused on this very digital, intangible asset class. And I think where the markets are actually going to move is into the tangible class, which even means, so there's going to be a lot of disruptive nature around the existing exchanges, as well as new market formation using these best practices. So it's really, they're very interconnected, I guess, is really the point. This isn't something that's dropped in from Mars. This is really an extension of existing systems, but it's a systemic shift and use cases for digital assets. Regulators are still up in the air. I think they all either were afraid of Bitcoin or are trying to understand Bitcoin or all the related, the pre and post ICO metrics. But now you've got a new stream of use case that are really penetrating markets. So the digital asset, or an asset-backed token, or commoditization of the digital space, I think is really where we're headed. Regulators haven't gotten it right yet, that's for sure. I think, as an example, Hong Kong just coming up with some new announcements in the last day or so. So it's going to be an interesting evolution going forward.
Honestly, just recently, as you've mentioned, actually, there are new regulations are coming in Hong Kong. So actually, they may in a different way influence as well digital assets and how they really regulate it. What are your thoughts on that?
I don't think it's competition, right? You've got very strong existing exchange, especially in Hong Kong. The Hong Kong Exchange and Clearing Corporation basically has a monopoly. And the SFC as a regulator is a very strong supporter of that. And they've created a lot of value and a very good regulatory infrastructure. I think the biggest challenge for them there's actually been deregulated OTC markets that have evolved outside of that in Hong Kong very successfully. And their biggest fear now is really cross-border penetration with mainland China. Some very sophisticated, not necessarily fraudulent, you don't have to use the word fraud, but they're definitely outside of the regulatory metric, and the potential really FATF, FATF, and AML, terrorist financing, is really the pressure that's being brought down from the top to regulate these industries or not allow them to expand from their current roles into the digital space use case. So it's just a tightening up. Most of those businesses actually still exist. One of them in particular is the gold business, and how gold is going from traditional physical flows into digital flows. So they want to close that loophole.
Thank you. I believe
If I may complement that a little bit. So if you follow things like Carlota Perez theory on technology innovation in financial markets, typically you have the technology wave first and regulation follows. In a lot of what happened with crypto, I feel like I spent years of my life building quant systems in Wall Street, and at the time we were sort of on the cutting edge of things that we didn't know how they could be regulated, but regulators, eventually caught up to it. I think given that crypto is all digital, it's all programmable, it's a brand new asset class, adapting existing regulation to this new asset class is far from trivial. And I think that's a lot of the struggle that you're seeing. And out of fear, like Thomas was saying, a lot of times regulators have been trying to anticipate things that they don't even understand, right? And typically history teaches us that, you know, technology should come first. You need to let us break a few things and then regulate after, right? If you try to over-regulate too soon, then you start doing things that don't make any sense.
Yeah.
Yeah.
Go ahead.
Who wanted to drop in?
Yeah, I was going to say, I mean, I think when you start to look at it, right, when we engage with the regulators, like the governance structure around these unregulated exchanges are something that a lot of people don't, you know, really understand, right? If you look at, you know, the example with what happened with OKX or the exchange in Canada, the idea that basically you have retail investors, you know, that can access these exchange, trade assets, hold funds there, right? And general basis, these exchanges are also for a lot of retail investors acting as a general custodian, given the complexity in a lot of ways of holding your own digital asset. There's a lot of systemic risks with this concept, right? That basically there is a single point of failure. And as you think about like the governance structure around, you know, regulated exchanges, this idea that basically one person or a group of people can represent a systemic failure from the governance and kind of the custody of assets is something that doesn't exist, right? So as they start to just kind of transport the framework by which they kind of regulate these institutions, they're learning more about it, and they're seeing these examples that now kind of bring a bit of fear as a regulator of, you know, if something really does go wrong, I, as a regulator, would be accountable or responsible for kind of managing the systemic risk, right? And so you're seeing them kind of propagate the regulations that you see on traditional exchanges on down to, you know, a lot of these unregulated exchanges. Because if you start to look at, you know, exchanges in Germany, for example, that are looking at more regulated products, really the regulators are giving them the freedom to kind of explore and innovate, right? They're not, you know, you look at SocGen and what they're doing with tokenized assets, Deutsche Börse and what they're thinking about doing. There's so many other kind of regulated exchanges that in the traditional markets, given the governance infrastructure that exists at those exchanges, are being allowed to innovate, right? Because, you know, they understand, you know, the model, right? The governance model there. And now they're thinking about the things at the edges. How do we think about the concept of transfer agents and all these other kind of core components that as you start to, you know, implement digital assets, right, kind of might shift, right? And so you need to adapt the framework slightly to meet kind of the, you know, the technological advancements that these tokens then offer. So, you know, they are going to take some time to get it right, but I think they have a kind of a fiduciary duty on the retail side to make sure that, you know, money that comes into that system is safeguarded and is kept in a way that doesn't necessarily propagate risk down to the end retail investor.
Mm-hmm.
Thank you so much, Stefan. The only thing I'll tell you, like, we would definitely additionally should talk about the regulatory clarity. It would be a different topic, and it would take a lot of time. But I would like actually still go back to the analysis of digital assets, because it's our core topic, main topic today. So coming back to HESIS, I know that you are using AI, artificial intelligence, for your firm analysis of digital assets. And please tell us about this more, because I'll definitely, I'm sure that you have a lot to share with us.
Yeah, so quickly, so what IntoTheBlock does is we use modern data science and machine learning to try to extrapolate insights from crypto assets, both for a retail audience, as well as we have we're working on fairly sophisticated things like machine learning driven quant strategies and things like that, with many quant desks around the crypto space. The fascinating thing about this challenge, so today IntoTheBlock has over 100 clients on the institutional side, and is as well as a dozen of clients on the fund side, including many of the names that you would recognize at Binance, CoinMarketCap, Bitstamp, and others. So the fascinating thing about this challenge is that crypto is a completely digital asset class. So a large percentage of what happened in any crypto transaction is visible. in some shape or form, not directly, but it's manifested somehow in blockchain records and other things. And then it just happened that time-wise, crypto coincide with the mainstream adoption of machine learning and deep learning technologies that were not, the research was out since the 80s, but the technology was not possible before. So you're seeing a revolution happening on the AI front. That is changing capital markets, and then you have a completely native digital asset class. So the combination of the two is fascinating. So what we try to apply techniques at what Google, Microsoft, Uber, Netflix, LinkedIn, these guys are doing. We're trying to apply those techniques to massive data sets of whether it's blockchain data, order books, derivatives, alternative data like Twitter, Telegram, and all that, and extrapolate insights about this new asset class that sort of democratize the playing field, right? Because we think crypto is the first asset class in which the most sophisticated quant fund or the most mediocre retail investor could have access to the same type of information, because it's all out there. And at the same token, you have the opportunity of reimagining things like portfolio analytics and things like that hasn't changed in decades, right? We're still using the same stupid metrics that we have been using since the 90s. And you have a brand new data sets in front of you that could help you reimagine all those fields.
Understood. By the way, coming back, as you mentioned, like previously, I believe that Anton had something to add here, but or we'll drop to the other question.
I'm happy to. Yeah, I'm happy to just provide a bit of my input. And since I'm the crypto dinosaur, let me take you on this journey in history, how things evolved from a perspective how people classify digital assets. Yeah.
As Jesus mentioned, like it was in the 90s, and now we're going to crypto dinosaurs.
Now we're going to back to 2000. So first, to make a statement, actually, if you're put in any point of time and do an analysis, it's very typical for people, for humans, actually to do a top-down analysis, and then they actually think that the infrastructure, the market structure, evolved top-down as well, which is usually not the case. And now I mentioned that because let me bring you back in history, actually. So in 2013, actually, when I actually got involved in digital asset world, it was actually very interesting that every digital asset was actually a cryptocurrency. It had its own blockchain, actually. It was very standard, actually, that everything you would touch would actually have its own blockchain. Of course, some people are a bit more creative than the others, and there was a lot of forks, but everything was a cryptocurrency, actually. And only later on, when people realized, wow, actually, we can create a digital asset that doesn't have its own blockchain, but can be on another blockchain, then kind of people started thinking about different kind of type of tokens. And people maybe don't recall, but the first ICO or crowdfunding happened in 2013, which was called the Megacoin. People don't know it by the name Megacoin today. It's called actually OmniLayer that issued Tether. So this was actually the first ICO where people realized, why don't we actually wrap or create tokens on a different blockchain? And then kind of people started thinking about it. They said, well, this is a coin, but it's not a cryptocurrency. And then they came with the term, it's actually a utility token because it kind of does something on a particular blockchain, And this is how things evolved. And now coming back to, we understand, okay, we have the cryptocurrency, or the payment tokens, somebody called them like that. We have the utility tokens, and how did the security tokens came about? And it's very interesting because, as you mentioned, I issued, as far as I know, one of the first security tokens globally. And I remember when people would come to me and say, what does your coin do? How do you mine it? And I would tell them, you don't mine it. It's shares of a company. You don't mine shares of a company. But I'm just trying to illustrate to you that usually this evolution happens not the way we actually anticipated normally. Yeah? So today we know, okay, there are non-security tokens, security tokens. Non-security tokens are being split into payment and utility tokens. Then you have kind of different category of security tokens. So kind of we know it today when you do a top-down analysis. Now, then what's very interesting is that, again, the infrastructure doesn't evolve actually top down, but bottom up, right? So when people tell to people today, we offer market making solutions. So they tell me, so you're an exchange member. And I tell them, no, we are not an exchange member. There is no exchange members on digital asset exchanges because everybody has direct market access. And then they look at me, they say, well, that's very weird. Why should everybody have an access to a marketplace? And I say, well, that's how the market structure evolved. In the similar point is, in traditional world, You cannot have a client out of Singapore trading against someone out of Switzerland. It just doesn't happen. Either you trade in Switzerland or you trade in Singapore. And a few years ago, I actually got asked the question, if you have a client in Singapore and a client in Switzerland, they trade, where does the trade happen? A regulator actually asked me that. I told them, well, the trade actually happens in the cloud. You know, in this digital world where you don't really have physical borders. But again, this is just an illustration actually that this evolution of both digital assets, infrastructure as well, which is the point of our discussion, actually evolves a lot different and a lot counterintuitive than if you'd actually do a top-down analysis, you know. And I think that's kind of the point I'm trying to make, and really what Stephen actually mentioned, kind of we need to have the flexibility to explore, to find the right models, but many times these models will not be intuitive for regulators, because the regulators will put you in the framework they operate now, and then they ask you, how are you not an exchange member? But because I thought that actually anybody who trades directly on exchange is an exchange member, and you have to explain to them the context and educate them, and then hopefully they see the same big vision and the big opportunity like we all do here.
Mm-hmm. Mm-hmm.
That's for sure. Did somebody wanted to add something?
Yeah, I mean, a quick point there to complement. I think so. About a year and a half ago, I probably published over 60 papers related to security tokens and Fisher, and I think most of those turn out to be wrong. Because the space hasn't really evolved as fast as we all wanted to. But one of the ideas that we explored at the time that Anton brought me back to it with his argument is that, so if in one side you have a completely digital asset class, all programmable, and on the other side you have regulations from the last century, right, trying to catch up, a way to see all this digitization of assets and things like that is as a way to make regulation programmable. So in some way, obviously, we have to have laws and regulations that apply in the non-digital, in the physical world, but maybe there is a programmable representation of those. Like as we make assets digital, as we make accounting programmable, maybe regulation is programmable too. And then you have a way, like you see what Securitize is doing with the DS protocol and things like that, of embedding certain regulatory constraints at the protocol level. And I think there is some of that is the idea is very meritorious, right? To start embedding different regulation constructs at the blockchain level in the form of smart contracts that could be enforced across the board.
Mm-hmm. Mm-hmm. Yeah, I agree with you fully on that. And actually, we're trying to do that. When we sat down with the regulators for creating a commodity asset-backed token, they scratched their head because we actually didn't fit into any of their little squares. They thought we were going to be an STO, but we're not. We're not a security. We're a commodity. So we actually got a very light touch from a regulatory standpoint on the product construct, a very heavy-handed touch on how do you do clearing, settlement, de-risk, and default fund methodologies and everything. We said, well, here's our smart contract. We embedded regulatory frameworks in our smart contract to avoid, we de-risked it fundamentally and actually made it easy for the regulators because we wanted to have good best practices. They're still asking us to explain it. So it's entertaining at times, but anyway, we're trying to bring the best of old school into the new school and combine them through the technology. Yeah.
That's for sure. Actually, one of the trends I would say that I heard like throughout all of these years, after, of course, we're not talking about the major cryptocurrencies, but about digitized assets. So one of the trends, everything will be digitized. And theoretically, it seems like it is possible and it will be actually hopefully done in the year. But probably in this case, the regulatory framework is actually the background, the drawback for this. Can you say, like, they were saying like in 10 years, everything will be digitized. And still a lot of companies now are trying to provide infrastructure to make really the assets, to help the companies to digitize their assets. So tell us more, how this is going, this process to digitize assets, and where do we see the space for liquidity here?
Yeah, I mean, I guess I can speak really quickly to a couple of things. I think if you start to really engage with financial institutions at the moment, right, they're still trying to understand the business cases behind digitization, right? Or if you look at formerly when I was a consultant, everyone was starting to shift things towards the cloud. They're starting to shift things into ledgers. They move things from paper. I mean, that's a process that was taking place like 2 years ago, right? 2 or 3 years ago, folks were just starting to shift things from paper-based models and distributed SQL databases into cloud-based infrastructure that could be shared geographically across their different business units. They're still working on that journey today. And so, when they then start to explore what does it mean to make everything digital, there's a real question in terms of what is the business uplift that we're going to kind of see from going towards this digital landscape, right? What is the impacts to my business? How does it shape my risk and operations? How does it shape my current business opportunities? And then is it really worth it, right? And you basically, as you start to really engage, that's the first question that comes up. I think the second piece is Fireblocks is an infrastructure company, so we focus on secure digital asset infrastructure, providing that for both the custody, tokenization, issuance, etc. When we engage with regulators, there's just even a fundamental question of how do you do what you do and what is the impact? Like, we don't understand how to regulate you as a technology company, right? You would say that, let's look at FIS, right? And they provide core banking technology to banks, ledgers. If something goes wrong there, I think a few months ago, FIS had an outage that caused problems at, I think, Signature Bank in the United States and a few other banks. Core and fundamental, not regulated. But you're starting to see regulation that's happening with SFC, with MAS, where even providers or technology providers like ourselves are kind of in the crosshairs of regulation by virtue of just engaging in the digital space, right? And so there's a lot of real questions. There's a lot of real uncertainty before you even say everything is going digital, in terms of how the regulators want things to go digital, right? How they look at technology applications in the space and the movement of those technology applications in the space. You still have regulators talking about cold storage and multi-sig. For example, we're an MPC provider, right? There's a lack of understanding even there. So, I do think that there is eventually a business case for streamlining and optimizing as folks have to look at their balance sheets, as folks have to look at operational implications and basically cogs in their business. Digital does make sense, right? The distribution of information, how that works, the settlement efficiencies, and all those things make a lot of sense, right? But the ability for the regulator to catch up to the technology and the innovation in technology that's outpacing that regulation, is something that I think will be a hindrance to real digitalization of everything within the next 5 years, right? I think you're going to see certain markets where it really makes sense. For example, private placements at banks, that makes a lot of sense to digitize. It's completely in paper. It's very difficult to manage. But the question becomes, well, are U.S. Treasuries really going to get tokenized, right? Are significant bond issuance is going to get tokenized in scale? Fiat, right? How is CBDCs going to work with with large financial institutions? What does that mean? So I think there's still a little bit of, I don't see it happening like digital everything in the next 5 years. I think there are going to be pockets where regulators can understand the technology that will kind of empower, enable that, and then kind of innovate from there gradually over time.
But do you agree that, for example, one of the last reports by World Economic Forum that 10% of GDP will be on blockchain by 2027? Is it like, are we going there, or is it like very bright in this case prediction and forecast?
You want to go ahead, Tom?
No, go ahead, Anton. Go ahead.
Yes, Anton. I'm happy to be the provocative person and say absolutely not 10%, but you will have 100% of assets digitized. And it might seem.
Steven, do you agree with this in this case? Like, we have I think 2 contradictory opinions on that.
I'm happy, but I really think maybe, the timeline of 7 years is a bit aggressive, but basically, if I just kind of reflect, 20 years ago, people talked about the internet. They said, well, why should everything be digital? Why should every piece of information be digital? And today we're having a panel fully digital. None of us is even in the same room. I mean, Tom, good colleague is in Singapore, and I'm in Zurich, so kind of like if you take that as a reference, you would say, okay, maybe every digital asset that makes sense will be digitized. And I kind of like make that as a statement, but maybe the 7-year time horizon is a bit aggressive, but I think we're definitely getting there. And that's why you have, service providers and infrastructure players like Fireblocks, like AirCarbon, that are putting these building blocks in our ecosystem together such that we achieve this vision, But I kind of also very much agree what Steven said. I was just nodding my head all the time, is like, what we all want to achieve is actually that we deploy technology. We employ a piece of the infrastructure. And it's very important to understand that from a company perspective is actually that being highly regulated, I know this is now maybe also controversial to say, being highly regulated constrains you. And even VCs tell me openly, say the moment you become a bank or you build something, your valuation actually goes down. Because whatever you had in mind to do before, you're not going to be able to do it so easily going forward. But the key for success, again, counterintuitively, is regulation. Because all of us here have to be highly, highly regulated and deploy amazing service and amazing technology for this vision, that I said 100%, everything that's imaginable will be digitized is going to happen. So it's very, very counterintuitive. We need freedom, but in the end, to achieve massive success, we need regulation. And how to marry the two together, I think that, what will actually differentiate success stories from not success stories.
I think just one quick question, and also I'd like to proceed with Thomas, that crypto anarchists, they were here because they were against the regulations. Now we still understand that for the crypto to enter mass adoption, we still a lot of we need to have clear regulations on that. So what are your thoughts on that? Where is like the golden middle here?
Educate the regulators. And I've actually done that a lot in my career. Fortunately, I've got, and it's a balance between allowing you to grow and be entrepreneurial or push the boundaries of markets architecture, at the same time sort of drag people out of, not out of the darkness, but just go, come on, speed it up. I believe in very short order, everything's going to be digital. And one of the strong points for me when I first looked at blockchain was back in 2013, and I got to look at blockchain relative to gold and how you could take gold basically from source to a refined product in a vault and ownership. And this goes, there's always been about, good gold, bad gold, where's it coming from? Is it money laundering gold? Is it is it just, is the gold that you're buying actually gold? That kind of stuff. You can create that proof on a blockchain and a distributed ledger. And that was so I went, well, we can do this with traditional markets architecture. So that's how I started to look at it from relative to commodities. Because commodities in the exchange world, like a CME or an ICE or the London or European markets, those are silos, right? They're very specific products, but their price has an implication across globally. So if you're looking at the price of corn in Chicago or soybeans in Dalian, China, it's not just in those two cities. The impact is global. It's global in trade finance and everything. But they're all very not connected. Somebody produces a price in Dalian and a bank in Chongqing, 3,000 kilometers away, takes it as their mark-to-market price for their farmers and their transportation industry. What's the connection? The connection is only the price, not performance. You get a lot of disconnections in clarity. So that's an extreme example, but in digital world, you can connect every single part of the life cycle of an underlying product or an asset, as well as all the digital ownership from a producer, from a miner in terms of gold, all the way to the refiner and every subsequent movement of that product after that. I sell it to the 4 other people on this page, right? And we can see it. You see the whole daisy chain connected. The current market architecture that we trade, the financial market architecture, is not connected like that. Actually, you've got, so when you take $1 and I go spend it on Queens Road in Hong Kong, as soon as that dollar leaves my hand, it goes to another person. The chain of ownership, the chain of transference, is gone, because I don't know where that dollar goes after that, right? Yet the demand is for us to have that traceability in a digital world from a regulatory perspective, and systemically capable to do it. Sorry.
Thank you, Thomas. I would love to proceed. The only thing with just how we need almost to wrap up. The only quick question: what do you think? What will happen in digital asset space in 2021? Quick question, quick answer, and then we will finish. Anton, please, quickly.
Yeah. So first, it was a pleasure to be part of the panel with some of the pioneers, and I hopefully very soon dinosaurs of the crypto world as well. And on my side, I mean, seeing what's happening behind the scenes in the digital asset world, the quality of the infrastructure that's being deployed, in the last years and going forward, I'm very optimistic about the next amazing bull rally that we'll have in the digital asset world. But this time, it will be bigger because you will have the infrastructure to onboard institutional investors, actually, because that was not the case in 2017. We did not have the infrastructure if we really wanted to onboard really, really big players. We will have that because of the quality of the infrastructure in the next bull rally, which makes me very optimistic and very bullish on our industry. And I see that we are going to get closer to that vision of everything being digitized, where you challenged me a little bit. So this is my final message. Yeah.
Thank you, Anton. He's just very, very quickly.
Yeah, so if we're talking about only 2021, I'm actually going to disagree with Anton about this. I think looking at the data that we analyze on crypto markets, we think there has been a lot of episodes this year that might make institutions very concerned about deploying real capital into crypto just in the next 12 months. What I think for 2021, I'll be looking for some movements, particularly DeFi, that are really pushing the level of innovation in the space, and it's real and they're material and they're challenging conventional wisdom. And I think that's a type of market that could really take digital assets to the next level. There are others, NFTs and all, but I think DeFi with the momentum behind it for the next year is particularly interesting.
Thank you, Stefan. Really
yeah,
quickly.
I mean, I think the payment space is going to be really interesting, right? And the emergence of basically, globalized movement of fiat currencies in a pretty efficient way, and what folks are going to be able to do with take Libra and other, providers that are starting to emerge in this space, that basically will enable more efficient fiat movement, and what that really will do to drive, digital adoption at the lowest levels down the chain. So I think that's going to be a really interesting thing to watch, and how that infrastructure evolves.
Thank you, Stefan. And Thomas.
I think CBDCs are going to be the next thing. COVID's still banging around most of the world, and I think the central banks have got that's going to be their adoption. If they get that right, everything else will fall in line.
We should definitely follow it. Thank you so much, Stephen, Jesus, Anton, and Thomas. I'm Maria. Please proceed watching Hong Kong Blockchain Week. A lot to watch, and see you soon. Bye.
Thank you.
Thank you.
Thanks.
Thanks.